Bismillahirrahmanirrahim. Rabbi shrah li sadri wa yassir li amri wahlul 'uqdatam min lisani yafqahu qawli. Amin. Ya rabbal alamin. Okay, let us continue the session that we had last week. So today it would be, the continuation for this slide still. So we will do accounting equation. So what does it mean by accounting equation? This is the basic principle of accounting that you need to understand. In accounting, the account, especially the balance sheet or the statement of financial position, it must be balanced, it must be equal. So I did mention, when I showed to you the financial statement of Nestle, I did mention that statement of financial position will always have an equal balance at the asset side with the balance at the equity plus liability, right? So that is accounting equation. So let us continue to explain further on what is accounting equation. So it always about asset and liabilities plus equity. The total asset will always equal to liabilities plus equity. As I showed to you, right, the total asset of Nestle is equal to the total liabilities plus Nestle. Okay, so that's it. Yeah, it must be equal. And then just imagine yourself, if you buy a house, right? I did use the same example last week. If you buy a house, yeah, let's say the price of the house, let me show you. Okay, I have that example after this, yeah. So if you buy a house, so let's say using your own money, which is equity, let's say you come up with 10% of deposit, right? And then the rest 90% would be coming from financing from the bank. So this is the 10%, this is the 90%. It will always equal to the amount of assets that you bought. Yeah, so the liability, the amount that you owe to third party, and the amount that you own from your own money. Yeah, so it always equal to the assets. Let us see the example. Before that, let us try to understand what are assets, liability, and equity. I did also explain before this. Okay, an asset is a resource with economic value. Economic value means it has the monetary value, or it has the implication to the economic well-being of the company. So it has economic value that an individual, corporation, or country owns or controls with the expectation that it will provide future benefit. So an asset is something that gives us future benefit. For example, when you have a house, the future benefit that you own from the house is you can occupy the house. So the same goes to the company when they own a building. So the future benefit that they will get from the building is they can occupy the building, they can operate from that building, meaning that they can start the business in the buildings. They can make it as a factory, they can make it as a office, administrative office, so they can occupy the building. So when they own a machinery, for example, so the future benefit is definitely they can use the machinery for the production, right? And then when they own a motor vehicle, the future benefit is they can use the motor vehicle to transport their staff, to transport their goods and services. So those are the future benefits. Okay, and then assets are bought or created to increase the firm's value or benefit of the firm's operation. So asset, whether it is a building, it is a motor vehicle or machinery, it is bought or created to increase the firm's value. So what does it mean by increasing firm value is, of course, it will be able to be used for the business, to run the business. For example, when machinery is used to produce the goods, so definitely by selling the goods, the company can increase the value. Yeah, for example, before this, they start with 1 million capital. So by producing goods and then by selling the goods, definitely they can make a profit, which will increase the value of the company. From 1 million, it will increase to 1.2 million, for example, from the profit that they make. Yeah. And then it can benefit the firm's operation. Of course, the firms can start operating in the building. They can use the motor vehicle that they have to transport the goods that they produce. And of course, machinery can be used to produce goods. Yeah. So all those will be benefiting the firm's operation. Okay, an asset that can be thought of as something that in the future can generate cash flow, reduce expenses, and improve sales. So just imagine the three items that I mentioned. If the company have own building, so definitely it can generate cash flow in the form of they can start operation in the building, and then of course they can do the sales, they can start generate sales. So when they generate sales, of course cash flow will come in. And then if they rent out the building, also the renting can generate income for the company as well. So just imagine machinery, of course, when it is used to produce goods, definitely the goods can be sold, and then it will generate cash flow to the company. Yeah. And then reduce expenses. What does it mean? By having their own machinery, they don't have to rent the machinery from other people, because or building, when they own the building, they don't have to rent the building from other company, other people. So that is that it will enable them to reduce their expenditure, right? And improve sales. So definitely, as I mentioned, if they have a building, they can start operating, they can start doing the sales. If they have machinery, they can start produce good, so that they can improve the income or the sales of the company. So that's the benefit of having assets. And then assets can be broadly categorized into short-term or current assets, fixed asset, financial investment, or intangible asset. Yes, so what does it mean by short-term? Short-term asset or current asset, usually the lifespan is about 1 year or below. Example of current asset are cash in the petty cash, or they can have cash in the bank, or any fixed deposit in the bank, or any short-term instrument. Yeah, so company usually they will have a short-term investment because they want to use the money, so they put the money on short-term investment only. And then that is the example of current asset. Anybody know what other current asset in the company, apart from money, apart from cash in the bank, cash in the petty cash, or short-term investment? What are other type of current asset? Anybody know? Or short-term asset? Munira?
Yes, madam.
Do you know any example of current asset other than the one I mentioned about the the money in the bank, the money in the petty cash? Other than that, what are other type of short-term asset for a business? What about goods that they buy because they want to sell the goods? Inventory.
Yes, inventory.
Yeah, inventory or stocks. So usually company, when they buy inventory or they buy stocks, they will sell it within that year. Yeah, so they will make sure that the inventory that they bought will be sold within that particular year as well. They cannot retain the stocks in the go down. They cannot retain because it will be a loss to the company, so they will sell it within 1 year. So that's why it is one of the category of short-term asset. Yeah. Other than that, do you know that when the customer bought goods from the company or services, are they buying on cash or on credit? If the business is big, of course, if the company is like the grocery shop in our neighborhood, definitely they don't have credit term sale, but sometimes they also have credit term sale. Like grocery shop, they will sell to their regular customer on credit term. Are you familiar with that? For example, our parents previously, they will go to the grocery shop in the neighborhood, and then they will have credit term. They will take all the item and write down the amount that they took, and then at the end of the month, they will pay all the total amount that they bought in that particular year, a particular month. Have you have experience like that? yeah, in our neighborhood. Maybe you're still young, you don't have that particular experience, yeah, but previously that's the way our elderly, our ancestors doing the business. They will have that credit term with the regular shop in the neighborhood. So usually big company like Nestle, big company like Tesco, they will do transaction based on credit term. They won't do it on cash, yeah. So when they do that on credit term, let's say the customer who bought their assets, their goods, yeah. So when the customer bought the item on credit, the customer will have to pay within certain period, which is agreeable to both parties. For example, within 60 days, for example. So the amount that the customer owe to the company is something that will be received by the company in the future. That's why it is known as receivable. Yeah, the item is known as receivable. So receivable usually it will be within 1 year only. They won't allow the customer to owe them more than 1 year. Yes, so that's why it is part of short-term asset as well. Yeah, short-term asset. It is known as receivable. So because of trading, it is coming from the trade activities, it is known as trade receivable. Okay, if the company have something like they rent out the building, for example, part of the building they rent out, and then their tenant, let's say the tenant pay on annual basis. So when the tenant pay on annual basis, the amount of the rental will be also amount to be received in the future. So it is also part of receivable. So can be a short-term asset as well. Okay. Okay, so that's a short-term asset. Another type of asset is known as fixed asset. Fixed asset usually it is in terms of physical asset. For example, the building, the land, or the machinery, or motor vehicle. So all those are known as fixed asset, or other name of it is non-current or long-term asset. Yeah. So a fixed asset usually referring to the physical asset like land, building, plant, machinery, and motor vehicle. Okay, so that's fixed asset. Another type of asset is known as financial investment. Usually company, when they have a lot of money, they will put the money in investment. So usually this investment would be long term. That's why it is not categorized as short-term asset. It is known as financial investment, which is for 1 year and above. Yeah, financial investment. And then another category of asset is known as intangible asset. Intangible asset, as the name implies, it is intangible. The rest are considered tangible because you can see and then you can touch as well. Yeah, for example, you can touch the plant, you can touch the building, you can touch the motor vehicle, right? And then here, the short term, you can touch the inventory, and then you can you can see the good which is sold on credit, and then the amount to be received. All those are tangible. The one intangible is something that cannot be seen, cannot be touched. For example, we did discuss, I think, on the first day. Example of intangible asset, anybody remember?
The logo, the brand.
Yes, the brand name, the copyright, the trademark, the what else? Copyright, trademark, brand name, and also goodwill. So goodwill, okay, brand name, you know that, for example, for Nestle, they have this Nescafe. The name Nescafe having trademark, yeah, and then it also can be, you know, it can be a brand name which only Nestle can use that name. Milo, for example, only Nestle will use the cocoa powder with the name Milo. Nobody else can use. So it is a brand name owned by Nestle, and it's also under the trademark category where nobody else can use that. Yeah. Another one is goodwill. Goodwill is an amount of a value of asset which other people willing to pay higher than the intrinsic value. For example, when the company being taken over by another company, so let's say the value of asset is 2 billion, but the company that is taking over willing to pay 3 billion, for example, even though the value of asset is actually 2 billion, but because of this company is very good, have high potential to grow, so the company that is taking over willing to pay 3 billion. So the extra 1 billion is actually the goodwill, meaning that the goodwill of the company which other people willing to pay, right? So that's also a type of intangible asset. Okay. So assets are usually recorded in the balance sheet, or the statement of financial position, the one that we saw for Nestle, right? All the assets are recorded in statement of financial position, which is also known as balance sheet. So based on the concept of historical cost, so based on the price where the company pay when they purchase the asset. For example, the building when it is bought 10 years ago, the price is 2 million, for example. So it will still be recorded at 2 million historical cost, even though the value may be already increased. Because the increase in value will be recorded somewhere else in a reserve account, but the value of the asset itself will still be on historical cost. Okay, so that's how the recording is done for assets. Okay, adjusted for any improvement or aging. What does it mean here? Let's say the company, of course, the asset will be depreciated. For example, building, it will be depreciated. It will be used. It will be utilized. It will be, definitely depreciate in value. So the adjustment on the depreciation will be recorded separately. Yeah, so it will not be like reducing the historical cost. It still be recorded in historical cost, but the depreciation or the aging will be recorded somewhere else in another account. Yeah. Okay, we will see that later. Okay, improvement means if, let's say, the building is renovated, so the renovation will be shown somewhere else. Yeah, it's not in that particular historical cost itself. Okay, what are other example of asset? Okay, I already asked you, and then you also already give me. Yeah, so let us move to liabilities. Okay, a liability is defined as a company's legal financial debts or obligation that arise during the course of business operation. So meaning that the amount that the company owe other people, other parties, the amount that the company owe other parties. For example, when the company get a loan from bank, yeah, so it is a financial debts. Or when the company issue bonds to get money from investor to finance the project, it is also financial debts. Obligation arise during the course of business. For example, when the company buy inventory, they will buy from supplier, right? So again, the company on a big on a big capacity, usually they will buy the inventory on credit term. They won't pay cash. Example, Nestle, they bought, let's say they bought 100 cartons of Milo from Nestle. So when they bought the Milo from Nestle, they won't be paying cash. They will be on credit term. So credit term that they have with the supplier is known as obligation. So obligation, the obligation is known as liability. Okay, so liabilities are settled over time through the transfer of economic benefit, including money, goods, and services.
Doctor, why do they have to take it as a credit debt? Why can they like pay it cash?
Okay, that is actually to get more benefit from the business. If they buy cash, maybe they have limitation to pay cash. Let's say if the capital is 1 million, let's say the capital of the business is 1 million. So if they pay cash for everything, definitely they won't be able to grow bigger. So just imagine with that 1 million capital, they have to buy a building, they have to buy a motor vehicle, they have to buy machinery. So if they have to buy the inventory also on cash, so definitely they won't be able to grow. So that's why having financial aids from the third party, for example, taking a loan from the bank to finance the building, taking a loan from bank to buy the machinery, to buy motor vehicle. At the same time, they also take credit terms when they buy inventory. All those will help the business to grow. If not, it will take a long time for them to grow if they have to use cash. That is known as gearing. In order to be fast moving, of course they have to gear themselves. So gear is the term that we use when the company have to rely on debts to run the business. So that is something that is indispensable in business. They have to involve in that. That's why. May I know why are you asking that question below? Muhammad below, right? Muhammad,
Very low.
why do you ask that question? May I know what you have in mind?
Yeah, because like if it is like, for example, an Islamic business, you cannot borrow from the bank because they have interest. So what can you do?
Yeah, I understand. Because of many people believe that should be avoided, right? That should be avoided because we don't want to get involved with that because usually it has riba, right? That is why many scholars in Islamic finance, they are saying that in Islam actually that is not prohibited. That actually one of the transaction that is actually acceptable in Islam because if you look at Surah Al-Baqarah verse 282, the longest verse in the Quran, it's about how to record that transaction. So it is mentioned in Surah Al-Baqarah verse 282. If you are doing a transaction based on that, which is something that will create liability in the future, you need to record it down and put in written. So that verse is the longest verse in Quran, and it is about actually recording a transaction, which is a debt transaction. So if that is prohibited in Islam, or if that is something to be avoided in Islam, why the longest verse actually on how to record that transaction? Yeah, so that is why the scholar actually believe that it is not something that should be avoided in Islam. The only thing is we have to manage it properly. For example, in Islamic banking, we are using other transaction, which is not a debt transaction. We are using other transaction, for example, trade. But in trade, we can do a trade which is based on debt, so based on credit, but we don't involve riba. We don't actually involve riba with the credit term in sales, yeah, because what we are paying is exactly the amount of price of that item, but we pay later. Yeah, so it is acceptable in Islam. The only thing that we cannot trade in credit term is gold, silver, and also the money itself, right? But other than that, we can always pay at later date, right? It is allowed, it is acceptable. So in business, we cannot run away from the need of getting involved with credit term because it is one way to grow faster in business. Of course, if that, but usually they cannot do a cash term. I never found a business which is successful without having any credit or liabilities. Yeah, so it is like something indispensable. Yeah, let us never mind if let's say below, let's say you read somewhere that there is a company that's successful without having to take debt, then we can discuss in class. Yeah? Because as far as I'm concerned, all business have to get involved with debt, then only they can grow. Okay, so let us continue. Yeah, if you find a good reading about that, then you can share, yeah, in class. Okay, so let us continue. Liability are a vital aspect of a company because they are used to finance operation and pay for large expansion. So this is what I said. Yeah, in order to grow the business, we need to get third party to help finance the operation, and then also can help us to expand our business. They can also make transaction between businesses more efficient, yeah, because if we have to rely on cash, then of course the business will have a hiccup. Hiccup means it will not be smooth because sometimes we have to wait for the cash to be available, then only we can buy things. Yeah, so that's why credit terms is important in business. It will make sure that the business is smooth and efficient. Usually in the balance sheet or in the statement of financial position, liabilities usually recorded on the right side, which is in the contradict section to asset, yeah, to reflect that this is how the asset is being financed. So liabilities is actually how to finance the purchase of asset. To buy a house, we need to get the financing from bank, so that is liability. To buy a building, we have to get the financing from bank as well. Even to buy inventory, we have to buy on credit where there is a term, an amount which is payable to the creditors. So that is why it is known as accounts payable. Yeah, accounts payable are the amount that when we buy from the supplier or the vendor, we need to pay. Yeah, the word that we need to pay is known as payable. So accounts payable include the amount that the company owe to the supplier. Yeah, for example, Nestle and Tesco, when they buy item from Nestle, they buy, let's say, Milo, 10 cartons of Milo from Nestle. So the amount that they need to pay to Nestle it will be recorded at under accounts payable. So meaning that, or the exact name is trade payable. Trade payable is the amount that the company need to pay the creditors or the supplier of their goods. Liabilities also include loan, yeah, loan to the bank. Mortgage is the amount of loan that they took to buy properties, to buy building. So that is known as mortgage. Accrued expenses. What does it mean by accrued expenses? Accrued expenses is, for example, if the company rent a building, so but the amount of rental is not paid yet, yeah, so it is known as accrued expenses. So expenses is already incurred but not paid yet, so that is known as accrued expenses. Yeah, or in specific, sometimes if it is about rental, they will record it as rental payable, or if the accrued expenses is about utility bills. Yeah, for example, you use the electricity today, but you will pay at the end of, let's say, 3 months. Every 3 months you will pay the electricity bill. So but you already used the electricity bill, so that is known as accrued expenditure but not paid yet, you know. So it is known as accrued expenditure. But in specific, of course, when you have many types of expenditure where you don't pay yet, so it's good to name it specifically. For example, if it is about electricity bill not paid yet, so it's good to use the terms electricity bill payable. Yeah, or if it is about water bill payable, or if it is about the internet bill, yeah, internet bill payable. So payable expenses that is payable is known as accrued expenses. Yeah, so to be specific, you just name it properly. Yeah, utility bill payable, electricity bill payable, or internet bill payable, to reflect that it is actually expenditure which need to be paid, accrued but not paid yet, so it needs to be paid. That's why the word payable is to reflect that it is an amount that you still owe the service provider. Okay, all right. So I already explained about accrued expenses, right? So now, what is the deferred revenue? What is deferred revenue here? Deferred revenue is revenue or turnover or sales amount which already being paid by the buyer, but you don't deliver the goods yet. The good or services is not delivered yet. So that is deferred revenue. The money already being paid upfront, but you are yet to deliver the goods or services. So companies also do transaction like that. For example, let's say Nestle again, yeah, easy to reflect what is the transaction. Let's say Nestle, its niche product, for example, instant noodle. Let's say the sale of instant noodle during Ramadan very good. I'm just giving example because people want to stock the instant noodle at home. So Tesco maybe will order upfront, will order the bulk of inventory for instant noodle for Ramadan, because they believe that there will be many people buying instant noodles. So they will tell Nestle, okay, we want to buy 100 cartons of instant noodle in April because it's Ramadan. So they will pay in advance to Nestle, and then Nestle now keeping the money as a deferred revenue because they have to deliver the goods at a later date. So it can happen as well in business. Yeah, the buyer will pay in advance, so the seller will record it as deferred revenue because they know that this is liability. They already receive money, but they need to deliver. Okay. All right, so now we come to equity. Equity can be defined as the capital owned by the shareholders of the company. So usually equity, it starts with the capital provided by the shareholders. Before they start the business, they will put the money in the business and saying that, okay, this is our capital. Usually it is reflected by the amount of shares. Yes, so it is represented by the value of asset less the amount of liabilities on the asset. What does it mean is equity is equivalent to the value of asset. So for example, the company have building, have machinery, have motor vehicle, but the company still have debt to the bank. You know, in buying the property, for example, the building, they take a loan. Let's say the building is now 1 million, and then the loan is now left with 800,000. So 1 million, the value of asset, the value of asset 1 million minus the liability on that particular asset, which is 800,000. So meaning that 200,000 would be the equity, would be the asset which is owned by the company itself after deducting the amount that they still owe the bank. Okay, in business, equity is important because it represents the real value of one stake in an investment. Okay, in equity is important because it represents the real value of one stake in investment. So when the shareholder put the money in the business, and then at the same time the business also take loan from the bank. Yes, so the real value of shareholders' wealth is represented by the total asset minus the total liability. So it is the equity owned by the company. And when the company make profit, it will increase the equity and vice versa. So what does it mean? Yeah? When the company make profit from the business, definitely it will increase the the equity. So let us just draw a bit, yeah. Let's say the business start with 1 million. And then using this particular amount, the company buy building, the company buy motor vehicle, buy machinery, and they also buy inventory and raw material to produce good. Let's say that year, this is the capital, right? Capital. Okay, and then when they buy and make sale, let's say they manage to make a sale of 2 million. And then from the sale of 2 million, they make a profit. Let's say profit of 800,000. So now the profit of 800,000 will be added here as something the value add to the company after the year end finish. After the end of the after final year end, then this 800,000, the profit will be added into the capital. So now the capital will increase, meaning that the ownership of the shareholder will be now 1.8 million. So the total. Yeah, but if the company suffer loss, let's say the company suffer loss of 200,000 instead of 800 profit, they suffer loss. So the loss will be put here as well, the 200,000, which will result in, 1 million minus 200,000, it will be only 1.8, it will be only 800,000 left. So when the company suffer loss, it will reduce the equity. Okay. Okay. Do you want to explain equity in your own words? Anybody? Anybody? Munira, do you want to explain what is equity in your own words?
Is it like our money, but our money that we
that we put in business, that we business as capital.
Yeah. And yeah, if the business we making profit, then we will get the profit.
Yes, it will increase further our equity. If the company make profit, it will increase further the profit, the equity of the shareholder. This is what we always heard about. Have you ever heard the term of increase the shareholders' wealth or maximize the shareholders' wealth? Shareholders' wealth. I believe in the first class I did mention the objective of business is to increase the shareholders' wealth or to maximize the shareholders' wealth. So to maximize the shareholders' wealth, definitely the company need to make profit. Yeah, profit is important. With profit, then only the shareholders' wealth will be enhanced, right? If the company make loss, suffer loss, definitely the shareholders' wealth will be deteriorating. Will be minimized, will be reduced, right? Okay, let us move to the next one. Okay, what is accounting cycle? Okay, so accounting cycle is the process of accounting, how it will start and how it will end. It refer to the specific steps that are involved in completing the accounting process. So where accounting process start, where the accounting process end. It is the length of accounting cycle. The length of accounting cycle varies from company to company. Just imagine the example that we used before. A company which is a small company in our neighborhood, a small grocery shop, compared with a hypermarket such as Tesco. So definitely the accounting cycle different from these two companies, right? For the small grocery shop, definitely every day they will record how much the sale, and then at the end of the month or the year, they will record how much sale for that particular month. And then after that, at the year end will be how much the sale. And of course, to match the sale, to know how much profit, they have to record how much inventory that they bought from the supplier. So that's all. Yeah, but company like Nestle, definitely they have a lengthy process of accounting cycle. So definitely it involves the purchase of various type of item, and then they need to record how much the inventory have been sold on daily basis and then on monthly basis, because they have a lot of items that on offer. Yeah, and then when we look at the different type of business, for example, the one in property development compared to a trade company, consumer goods like the trading of consumer goods like Tesco, because the process is just about buying buying the stocks of good. For example, the product from Nestle, the product from FNN, the product from Dash Lady, and they put on the shelf, and then they will sell. So they will record the amount of sales, right? But compare the business with the business of property developer, when they have to buy the raw materials, they have to buy the bricks, they have to buy the the steel, and then from all these raw materials, they have to start constructing the building. So usually, if they build a house, a house in residential property, let's say they want to build 1,000 unit of house, so definitely the process will take at least 2 years to complete the construction of the houses. So it will take 2 years to complete the accounting cycle. And then just try to imagine how the accounting cycle would be for a company like plantation company. Plantation company like in Malaysia, we have IOI plantation, we have IJM plantation, which involve with the plantation of crude palm oil. Yes, we just imagine it will start from, when they start to plant the seed, and then the seed to become seedling, and then from seedling it will become, the small, and then they will transfer the sibling to the estate, in the estate, and then how many years when the fruit will be start, the plant will start having fruits, and then the fruits will be harvested, and then from the harvested fruit they have to send it to the refinery to get the oil being pressed. So all the process of plantation company, is it the same in terms of the accounting cycle with Tesco? Yeah, totally different, right? So that's what it meant here. Yeah, the length of accounting cycle varies from company to company. It may be monthly, quarterly, semi-annually, or annually, depending on when the financial statement of the company are published. So of course, usually the financial statement will be prepared on yearly basis at least, and then the completion period is known as financial year. So and then it can start in February, it can start in January, February, March, April. So it is not actually like every company have to end their financial year in December. Some company, they start in February, and then they end in 1st February start, they will end it on 31st January. And then when they start on 1st March, they will end on 28 April, February, because 1st March would be the start of their new year. So those are the financial year for companies. It can be, it can be any date. So of course, at the end of the period, they will have to prepare the financial statement. Okay, regardless of the timing of accounting cycle, the process involved remain the same. So the process involved remain the same, meaning that they have to record, and then they have to interpret, record, and then after that communicate the accounting information to the client, to the user. So this the accounting process or the accounting cycle. So first, they will collect and verify source document. For example, let's say Nestle, when they buy, or Tesco, yeah, when they buy the product from Nestle. Let's say they bought 100 cartons of Milo from Nestle. So the source document would be the invoice from Nestle, that Nestle already deliver the item to Tesco. So those are the source document of the purchase transaction, and then they will analyze transaction. So they will categorize, they will analyze what is this transaction is all about. When they look at the invoice, okay, so this invoice is about the purchase of 100 cartons of Milo. So it will be classified. Once they analyze, and then they will classify the transaction into each own type lah. For example, when they purchase the Milo, 100 carton of Milo from Nestle, it means that it is under purchase transaction. So they will generalize the transaction. It is a purchase transaction. So it will go into the journal, and then after that it will be posted into ledger. Ledger is an account which is specifically about the same transaction. So journal means they will list down all the transaction. For example, it will be chronological. For example, today is 1st April. So journal will be a list of transactions that happened on 1st April. For example, let's say in the morning they receive order of 100 carton of Milo. Then at 10 a.m. they receive 1,000 cartons of instant noodle. And then on let's say at 12 p.m. they receive 1,000 packs of rice from Faiza, for example, from another company. So they will list everything in journal, in a journal. So without considering without having separate journal, they will list everything in one journal for that particular day. And then after sometimes on weekly basis, sometimes on monthly basis, sometimes if the transaction is very big, they will do on daily basis. They will post to the ledger. Ledger means if it is about purchase of goods, it will go to the purchase purchase account. If it is about delivery of, let's say I mentioned about Nestle, and then instant noodle and rice, right? So the purchase of rice will go into the rice ledger. The purchase of instant noodle will go into the instant noodle ledger. So ledger means its own account, separate account itself. Yeah. And then after that, at the end of the month or the end of every quarter or every 6 months, they will prepare a trial balance. So what does it mean by trial balance? It is actually a list of accounts. This is about accounts, right? Separate account. For example, purchase account, purchase of rice, purchase of instant noodle, purchase of what else? Instant noodle, rice, and then another one is okay, Milo. Yeah. So the 3 accounts already been created, right? And then let's say they also make payment to Nestle. So there is one account which is about payment made to Nestle. So 4 accounts, these 4 accounts will be listed in the trial balance. So what is meant by trial balance? It is actually a statement to test that the recording is correct. So that's why it is known as trial balance. It will be recorded in the list to see whether the recording is done properly or not. If you ever heard the word debit and credit, do you ever heard the word credit and debit for accounting? Usually when we talk about accounting, you have to understand as well the debit and credit, okay? So what does it mean here? Usually when we purchase good, it will be, debit is like this, yeah? Account is usually they have this T account. This is the basic accounting type, yeah? They will prepare a T account whereby this is a debit side. The R is a debit, CR is credit, yeah? So this is actually debit. Let me put in full. This is credit. So what does it mean, debit and credit? For example, this is a cash account. So cash account, when it is about debit, means that when the company receive money, when they receive money from, let's say, shareholder put, let's say 1 million. So when the shareholders put money in the company, it will be a debit of cash. And then when the company use the money 1 million to, and then they buy, they use 800,000 to buy building. So it will be recorded in the credit transaction 800,000, which is actually about building. Yeah, so it will be recorded as building 800,000. This would be about capital 1 million. So this is what it meant by debit and credit. So at the end of the month, if this is the only transaction that the company have, at the end of the month, it will be closed. So how they will close? They will look at which side have a higher amount. So that would be the amount that will be the threshold lah. For example, here 1 million. So it will be the one that to balance the account, both sides. So now, which side will be having will have lesser amount? So you see here, the credit have 800,000. So means that to become 1 million, it need another 200, right? So here, what does it show here? The balance of cash now is another 200,000, right? 200,000. And then from this particular figure, it will be brought here. This is how to close the account. It will be transferred here to show that. So actually the money remains in the cash remains in the company is actually 200,000 at the debit side, which means that there is still an amount available, 200,000. So this will appear at the debit side of cash. So when they prepare the trial balance, so trial balance also it has two sides. So it will show the debit account and then the credit account. So here the cash will exist at the debit, which the amount shown will be 200,000.
This type of debit is not the type of debit and credit we know in normal bank account, right? It differs.
No, it's different. Actually, it's totally opposite to how bank classify debit and credit. Yeah, that's why when I teach accounting, I don't want to teach the accounts of bank yet, because it will be totally opposite the way they describe debit and credit. So that's why I always use the company like Nestle, because it's easier, and then further the terms do not conflict to the accounting term, because when we try to describe accounting for bank, it will a bit confusing, because they have their terms of debit credit that reflect how they debit our account, credit our account. So please don't associate to that lah. Yeah. So this is about how to understand when we look at the cash. So cash is a asset account, which is an asset to the company. So for an asset, when we receive more assets, it will be at the debit side. When we use the asset, it will be at the credit side. So for example, this one, when we have a new asset, 1 million, we will record it at the debit side. When we use the cash, we record it at the credit, means that we take out the money from the company's account. Okay, so that's what to understand debit and credit. And then trial balance means at the end of the period, for example, one month or 6 months, then the list of account will be presented in trial balance. So they will compile all the list of accounts. For example, here it will be about capital. The capital will be at the credit side, capital 1 million. Okay, and then here the building will be at the debit side, 800,000. Okay, so now whether the trial balance is balanced or not, here you can see capital 1,000. Here also 200 plus 800, also 1,000, means that it is actually equal. Yeah, it is balanced here and here. So when the balance is equal at both debit and credit, it shows that our recording is correct. So trial balance is to see whether our recording is correct or not. Yeah. Okay, so let us move to the next one. Okay, then from the trial balance, we have to prepare the worksheet. Means that we have to start preparing the financial statement. Yeah. So when the financial statement is prepared, of course, the three types will be prepared. The first one is statement of financial position, statement of comprehensive income, and statement of cash flow, right? And then after that, we will do the post-closing entry. So what does it mean is, if there is any adjustment to the account, it will appear in the post-closing entries to adjust anything that may be being missed out in the earlier recording. Okay, and then after that, we prepare a post-closing trial balance. So again, we prepare another trial balance to see whether the transaction is correct or not. Okay, so that's about the first slide. So let us move to the next slides. Yeah, so actually it's a continuity of this particular slides. Let me close down first. Okay, the second one. All right, hold on. I will share with you the second slide, which is actually the continuity of the continuity of the transaction. Okay, I don't have the slides now. Let me, okay. Right. So this is actually about transaction analysis and accounting record. Again, it will repeat about accounting equation, yeah. Come back to my class of principles of accounting and finance. Okay, this is actually the recorded version. So let me, okay, edit, not edit. Let me take out the narration. Okay, so let us see what is presented here. So it is actually like repeating but of course the accounting equation, but you will understand how a transaction is being recorded and analyzed and recorded. Yeah. So at the end of the session, you would be able to understand a fundamental concept and accounting equation in record keeping. Okay, you already understand what is accounting equation and how it is reflected in record keeping, and identify the types of accounting entries, explain rationale of double entry, and prepare the basic financial statement. Okay, so at the end of the session, you would see how the financial statement is being prepared. Yeah, it's simple one. And then you will learn what is double entry. Okay, just now I just mentioned about, for example, the shareholder put in capital and then you use the capital to buy, and then actually how every transaction is actually have to be recorded at both sides, debit and credit. Again, about accounting equation, asset will always equal to liability plus equity. Yeah, asset will always equal to liability plus equity. So this is what does it mean? Asset are whatever, how you use the fund. For example, you get the 1 million from your shareholders. How do you use the fund? You will use the fund to buy the building, to buy motor vehicle, to buy machinery, right? So it will be reflected in the list of assets. Okay, so now the assets, the one when you have the funds, when the capital provide or the shareholder provide the fund, definitely it has the sources. The sources, of course, the shareholders, right? So when you want to grow further the business, you will take loan, for example, to buy another machinery, more machinery to produce. So the money coming from the bank will be the liability. So you already have equity or equity ownership which the shareholder put in the business, and then you also have the liability from the bank. Yes, so the assets are economic resources, whether they are current asset or non-current asset. The liability are the obligation and that the company have on towards other third party. For example, the loan that they take from the bank. Yeah. And then the equity are the owner claim. So meaning that the owner of the company, the shareholder, they have the right to claim on the business assets. Yeah. So whether it is in terms of ordinary claim or preferred claim. What does it mean by ordinary claim or preferred claim? So it is the type of share that they are holding in the business. If they are the ordinary shareholder, so they have rights to votes in the business. They have the rights to get the profit distribution, if any. But preferred claim, the preferred shareholder would have a higher priority in terms of the distribution of profit. So that's why they are called preferred shareholders. Yeah. So usually the profit and promised to them in the form of fixed term. For example, it is like 6% dividend for that particular preferred share. Yeah. So so that's why in principle preferred share is non-compliant because it has a fixed return. For ordinary share, they don't have fixed return, so it is Sharia compliant. Preferred share usually a non-compliant instrument, okay? Because their return is fixed. So in Sharia, everything returns, if it is fixed, it is non-compliant. Okay, example of accounting equation. For example, you buy a car at market price of 140, 14,000 paid as down payment. So meaning that is your own money, using own money. The remaining coming from a bank. So meaning that 140 is the value of the car which you buy, and then 14,000 coming from down payment, which is your own money. The remaining 126 coming from loan. So loan is the liability to the bank. This is your equity. And then let's say you buy a house at market price of 500,000 and 50,000 paid as down payment. Then you wish using your own money. The remaining coming from the bank. So now you have to record a house which is 500,000, where 50,000 is coming from your own money, and the remaining 450 coming from the loan. So now in total, how much asset you have? Yeah, so at this moment, your financial position would be, you know, the total of a car and house, which is 640, and then the amount of equity is 64. You know, the 14,000 plus 50,000. And then now the loans or liability to the third party or to the bank is 126 plus 450, which is 576. So if you add the two items, 576 and 64, it will equal to 640. So meaning that here, asset equal to liability plus equity. Here as well, in the first transaction, you will see that asset will always equal to liability and equity. And when you buy the second item, you will always reflect it in the equation of asset equal to liability plus equity. So when you add up all the transaction, it will still show the assets always equal to liability plus equity. So every time you make a transaction in business, it will show the accounting equation. Yeah, it will be reflected in accounting equation. Okay.
Doctor, what is the difference between equity and capital?
Equity and capital. Okay. Capital is the term given to the amount provided by the shareholder. All right, so usually it will become a capital to the business. Equity is also representing the rights of the shareholders in the business. So, but it doesn't necessarily come in the form of capital. Capital is the amount that they initially provide to the company when, you know, shareholder, they put in 1 million each. Let's say there are 20 shareholders, all of them put in 1 million. So their capital individually in the company is 1 million. But as the company grow, as the company, you know, the company is run, let's say, for 5 years, every year the company will make profit. So when the company make profit, the amount of profit will be going into the equity part of the business, which means equity is not only that coming from the capital, but it can comes from the profit generated by the company, but it is also belong to the shareholder, meaning that the shareholder have right on the profit. So it's owner's shareholder's claim on the business. It will come in the form of profit generated by the business, which not distributed but is kept in the business. So it is part of the equity. So equity can be in the form of profit, which is retained in the business for the purpose of growing the business in future. Okay, so that's the difference between capital and equity. Okay, below.
Yes, it's good. Understood.
Okay, okay, let us see type of accounting entries. So there are a few types of accounting entries. For example, capital injection. I will explain one by one. Capital injection, asset acquisition, asset transformation, settlement of liabilities, revenue earned, expenses incurred, cash receipts, cash payments, and also dividend distribution. So we will go one by one to understand the type of what does it mean by this transaction. Okay, what is capital injection? Capital injection is an investment of capital into the company or institution, typically in the form of cash, equity, or debt. Yeah, so usually shareholders, they will put in cash in the business. So that is known as capital injection. Or sometimes the shareholder also can put in the equity. Okay. So they can put in equity as well. So meaning that they can, instead of cash, they put in an amount as a, you know, something like to guarantee that the business can always ask from them the money. Yeah, so and then it can be in terms of in the form of debt. For example, when the business take the debt from the bank, yeah, it is also a capital injection. It can be a capital injection as well, meaning that to increase further the amount of money that the company have so that they can do the business. Oftentimes, the word injection implies that the company or organization receiving funding may be in financial distress. So usually when the company being injected with capital, so they reflect that the company need capital. So that's why the capital being injected. However, the term also refer to all type of capital investment, including those made in startup. So it's not if the company is in the middle of business and then they need more capital injection. So usually because of they are in financial distress. However, capital injection also refer to a new startup. For example, when the company are just about to start the business, for example, an internet-based company, they need capital, right? When they want to start the business. So that is also known as capital injection. Okay, so or the company which is making profit, but they want to grow further the business. So that is also known as capital injection. So usually capital injection in private sector, usually in exchange for equity stake in the company from which the investor is investing. So usually when the capital is injected in the business, usually it will be reflected in the equity stake of the company. So what does it mean here? Usually it will be, you know, in return, the investor will have equity in the company. So let's say initially the company have 1 million capital. And then they will, when they require more capital, they will request from investor. So the new investor who put in the money will be given equity stake, meaning that they will be part of the shareholders. Capital injection can occur throughout the various life cycle of business. For example, financing in the form of capital injection may open seed round from family, friends, and hand-selected angel investors. So usually a startup company, sometimes they can start with a capital provided by family, by friends, or by family, or maybe angel investor. Angel investor is somebody that you don't know, but they are willing to help your business to start. So that they are known as angel investor. They are not friend, they are not family, but they are somebody with extra money and they are willing to help the startup company. So they are known as angel investor. In return, the investor receives portion of the company ownership. So all these investor will be the owner or the shareholders. So sometimes when the private company is a growth phase, so the company is in an expanding phase, sometimes they want to fund its momentum of growth, then the company can open series of investment round, or it can assume debt, both of which are capital injection. So when they want to grow further, sometimes they will issue new share, so that new investor can come in and buy the share, or sometimes they can also get it from debt. Yeah. So the decision whether they want to issue share or whether they want to take debt from bank, so it has is due to, you know, what are the implication that they want to the company. For example, if having a more shareholder by issuing shares, and then having another shareholder to come and join the list of shareholders, definitely have implication in the form of shareholder have say in the business. You know, for example, let's say, so far your companies are owned by all among your friends, the 20 of investors who are your friends. Suddenly when you want to grow the business, and then you got, let's say you got one investor who are interested, and he is one of the minister in your country, a politician. So what will be the implication? So definitely you will have to prepare yourself having another type of investor, which is now a minister. So definitely it will be different, right, for your company. So whether you want somebody else to be your shareholders or not. So that's the decision that you have to make. That's the preparation that you have to, you know, have when you want to have a new investor. Or another way, another option is you can take the loan from the bank. So when you take the loan from the bank, so bank won't become your shareholder. They won't interfere in your business. They will just give money, and then they will let you run the business. And then what they're interested in is you have to pay the money, the amount to them, and also the profit. If it is Islamic bank, the profit, they want you to pay the capital and profit to them, right? So so that's the implication if you take debt financing or you take loan from the bank. Different when you issue share and then you get new investor. Yeah, of course. Another difference is if you issue share, you don't have obligation to pay dividend. You don't have obligation to give profit, part of profit to the shareholder, because it is not compulsory. But if you take loan from the bank, you have to pay interest to the bank, or if it is Islamic bank, you have to pay profit to the bank, and then you have to pay the principal as well. There is no excuse. Every month you have to pay. So those are the implication if you have loans. Yeah, but if you have investment or share from your shareholder, so definitely it is not really like, you know, very burdening to the company. But of course you will have a shareholder who will be intervening your business, right? Okay, if a matured company decides to go public, to go public, it means the company decides to list their company and get the fund from public. So like go for listing on Bursa Malaysia, it is known as to go public. So if the company already matured, have 5 years of profit, so they will go public, and then the money earned through the issuance of share is also capital injection. So capital injection also can come from the listing activity of the company. Okay, so this is also example of capital injection. There are other ways that the company or organization can receive capital injection. Sometimes government will inject capital into struggling sectors to stabilize them for a public good. For example, Malaysia Airline in Malaysia, it's a few times the government have to inject capital into the business because of the business always make loss. Yeah, so Malaysia Airlines. So why the government keep on injecting capital? Because of it is a national company. Government have it is a company with national interest. So of course it cannot be a fail. So that fail the company. That's why company always help the government always help the company by giving more capital. Yeah, it is also known as capital injection. Okay, so this is what happened during financial crisis in 2008. US government also give capital injection to many banks in US. And then some of the banks until now do not recover. Yeah, for example, this Banca Monte di Paschi, which is an Italian bank. Yeah, the government of Italy give money to the company, but still the bailout failed. Yeah, it is known as bailout because when the government help, it is known as bailout. So the capital injection by the government still not able to revive the company. So that's why it is said that the bailout failed. So according to Bloomberg, in the year 2019 in January, the bank announced it would seek another round of capital through bond. So even though, you know, after many years, yeah, from 2008 to 2019, it's about 11 years, yeah, the bank still need a capital, another round of capital. So now they want to issue bond. So at that time, Italian government assumed 68% ownership in the bank. So in this Banca Monte di Paschi, the Italian government already owned 68% of ownership. In return of 5.8 billion euro injection and part of 8.3 billion euro recapitalization. The bank share have lost 70% of their value from the year 2017 to January 2019. So what does it mean here? Yeah, even though the government helped the bank, yeah, and this particular bank in specific, Banca Monte di Paschi, even though the Italian government helped them by injecting 8.3 billion euro, and in return the government have 68% of the ownership of the company, but still the bank make loss. Yeah, the company, which is a bank, make loss of 70% from their value just in 2 years period. So that show that capital injection sometimes fail. Okay, asset acquisition. Asset acquisition simply means that when, you know, when the company acquire building, they buy plant, they buy land, machinery, all are asset acquisition. So sometimes in a more complex transaction, asset acquisition refer to the purchase of another company or by buying the assets instead of its stock. So in most cases, asset acquisition typically also involve assumption of certain liability. However, because the parties can bargain over which asset will be acquired and which liability will be assumed, the transaction can be far more flexible in its structure and outcome than a merger, combination, or stock purchase. So what does it mean here is in business acquisition, sometimes they can reject some of the asset or liabilities that they don't think it will be adding value to the company. So they can choose which one they want to acquire. It is also defined as a buyout strategy in which key asset of the target company are purchased rather than its share. So they will identify what asset that they want to buy in the company. They won't buy everything. This is particularly popular in the case of bankrupt companies. So when the company going bankrupt, usually there will be another company that interested to buy some of the assets of the company. For example, let's say oil and gas company that are having problem financially, and then usually the business that will be the company that will be taking over them will choose which particular segment that is benefiting, that will be profitable to them. They will acquire certain business only. Further, the asset acquisition strategy may be pursued if the acquirer is interested in certain specific asset and not all the possible asset target. Okay, so this is an example of asset acquisition. IHH takes over Prince Court Medical Center for 1.02 billion. So this is a Malaysian takeover news, yeah. So where in this transaction, IHH Healthcare buying Prince Court Medical Center from the substantial shareholder Khazanah Nasional Berhad for 1.2 billion. And then the acquisition came slightly more than 1 year after Khazanah wholly owned unit Pulau Memutik Ventures bought the hospital operator from Petronas. The Pulau Memutik Ventures hold 26% of stake in IH. And then IH noted that the proposed acquisition will allow the healthcare providers to strengthen the position in the Malaysian private healthcare segment. Separately, Khazanah said that the proposed divestment will allow Prince Court Medical Center to fully benefit from being integrated into IHH Healthcare. So sometimes asset acquisition is targeted to value add the business of the group. Yeah, so that's why they will choose certain business only. Okay, what does it mean by asset transformation? Yeah, asset transformation is when the asset is transformed from one category to another category. For example, when a company have cash and then they use the cash to buy a factory. So the cash is transformed into a factory. So it is from the current asset transformed into a fixed asset. Yes, so current asset category or cash being transformed into fixed asset category, which is the factory. So it can be happening in two ways. So for example, the cash that the company have, they use the cash to buy the factory. So meaning that the current asset now being transformed into fixed asset. Or it can be vice versa, whereby when the company have a property like a factory, now they went to sell the factory. So now when they sold the factory, they have cash with them. So that is also one type of asset transformation. Okay, settlement of liability, as the name implies, it is when the company use the money to pay off the liability. It will reduce the amount of asset, at the same time reduce the amount of liability. Example, the company or a firm use its asset of 90,000 to pay off its remaining bank loan of 90,000. Here, the amount of cash will reduce by 90,000. At the same time, the amount of liability also reduced by 90,000. So that is known as settlement of liabilities. It reduced the liability. Or example 2, a firm takes a loan of 300,000 from bank PQR and pays off its creditor of 300. So it is in the form of, okay, this is the settlement of liability where liability reduced. But when the company take the money from bank, it is a creation of new liability. Yeah, it's like creation of new liability to pay off to settle one another liability. Okay. Revenue earned. Revenue is another word for sale or turnover. So for a firm, revenue is earned from business activities. If the business is about manufacturing of food products, And then the revenue would be from the sale of food product. Yes, so but if the firm ran out property, ran out part of its building, the rental income will not be part of revenue, but it will be classified as other income. Just like we saw when we look at the annual report of Nestle, yeah, you see the word sale, turnover, or revenue. It is about the sale of instant noodle, the sale of food and beverages like Milo, Nescafe, or the type of food. For example, the tomato sauce, chili sauce. Those are the sale of those items will made up the revenue or sale or turnover of Nestle. But if Nestle has large building and then it is renting out part of its building to another company, the rental of building will be classified as other income. It won't be added up to the sale or turnover or revenue of Nestle. It will be classified as other income. Okay. And in let's say in a very isolate case, usually companies sometimes will sell its building or sell its land or sell its factory or maybe its machinery, for example. So it is rarely happen. Usually if it happened, the sale proceed is not categorized as revenue because it is not recurring, and then it is not classified as other income as well. It will be classified as extraordinary income because those transactions are not happening on regular basis. Okay, so let us look at the next one, expenses incurred. In performing business activities, a firm will definitely incur expenses related to the business. For example, in producing the products to be sold, the company will incur expenses related to production of the products. For example, the cost of raw materials. Remember, Nestle, in producing the instant noodle, definitely they need to buy flour, they need to buy salt, right? And then they need to buy all the ingredient to make the instant noodle itself, to make the gravy, yeah? So all those are the cost of raw material. And then they also need labor. So it will have, of course, the cost of labor, the wages to the labor. And then the utilities related to the production, for example, the electricity bill, the water bill. So these are known as cost of goods sold. Expenditure related to production of goods is known as cost of goods sold. Yeah, it is specifically referring to the items being sold. So they will calculate all the costs related to the item that managed to be sold. Yes, for example, out of the let's say 1 million of carton of instant noodle, let's say for that year, Nestle managed to sell only 500,000. So they will calculate how much the cost of goods sold, the cost of the 500,000 carton of instant noodle that managed to be sold. So in order to identify what is the profit from the sale of that 500,000 carton of instant noodle. So they will calculate the cost of the cost of producing the 500,000 of instant noodle. That is known as cost of goods sold. In promoting the products, the firm may incur marketing, advertisement, and promotion costs. So, and then these are known as also sometimes it is clearly mentioned as marketing, advertisement, and promotion. Yeah, and then they also will incur general and administrative costs. For example, the salary of all the staff in the headquarters, the salary of the secretary to the bosses, and then the administrative costs. For example, the amount that they need to pay for the hospital benefit of the staff. All those are general and administrative expenditure, which is also another category of expenditure. All these expenditure need to be recorded in financial reporting as they will determine the amount of profit generated by the companies, right? Okay, cash receipt. The receipt of cash. Usually it will be coming from the sale transaction that involve cash. As I mentioned earlier, yeah, not all the sales will be done on cash. Not all purchase will be done on cash. Usually they will be on credit terms. But of course, there are small amount of sale or small amount of purchase that will be done on cash basis. So this particular cash transaction will be recorded. Yeah, if they receive cash, so of course, when they do sales, so they will receive cash. When they pay rental, for example, or they pay to the debtors, you know, so all those are the payment of cash. So all those are something to do with cash transaction. So cash receipt or cash paid will be recorded in cash account, which finally will be brought into the statement of financial position, or also known as balance sheet, at the end of financial year. So cash receipt is important in business as they determine the ability of the firm to survive. So it's very important to manage cash in the business. That is why a separate statement of cash flow is being, is being recorded, is being prepared to understand how cash is managed in the company. Without cash, the firm will have difficulties in paying off its short-term liabilities, which will disrupt the operation of the firm. Yeah, you just imagine if the company do not have enough cash to pay the creditors, if they do not have enough cash to pay the utility, definitely the water supply will be stopped, will be suspended. The electricity will be cut off. So that's the implication if they don't have enough cash. This explains the importance of cash flow, statement of cash flow, which reveal the movement of cash in the business, right? Okay, so this is about cash payment, which I already mentioned to you. Failure to pay installment to the bank, for example. Yeah, if let's say the company do not have enough cash and then they fail to pay installment to the bank, definitely it will result in the company being sued in court. Or the company not able to pay the utility bills, definitely it will result in the utilities being cut off or terminated. Okay, the last one, this is about dividend distribution. What does it mean by dividend distribution? It is actually the distribution of profit. Yeah, dividend distribution is the distribution of profit by the business to its shareholders. When the shareholder invests in business, they expect at least two types of income, which coming from dividend or capital gain. So dividend is one type of cash payment, but it will happen only after the firm determine how much profit it generates. If the firm make good profit, then definitely they will pay good dividend to the shareholders. For public listed company, the amount of dividend distributed will determine the price of the investor willing to pay on the shares. The higher the dividend payout, the higher the price that the investor would be willing to pay on the shares. Okay, so that's for today. Yeah, I will continue, or I will share with you the one that I already recorded earlier. So if you want to go through the transaction, yeah, and then I will also share with you the first assignment. It's not difficult, no worry. It's something that you can read, something that you can do on your own. Okay. Because it's already 9:30. I'm afraid if I continue, it will be very tiring for all of you. Okay, so any question before I end the class? Munira?
Doctor, what is the course that you recorded? What is it about?
Oh, the same one actually, but the one that I recorded with
the one that you recorded is
with the previous class. It's the same topic, but of course I finished it out. You know, there's a lot more, and then we have also the the example of transaction as well. So it's good if you can listen to that one as well, because it will like complete the what you learn for today. I will share that one as well. Yeah.
So now we have to listen to that recorded course.
Yes.
Oh, it's
Name it properly. So this one would be the lecture for today. So we'll name it properly. At the date, I will give the date, and then I will share the one that I recorded previous session. So for you to continue with the with the slides, because it's
which one do we have to start with? The one that you recorded first?
Yeah, this one first, and then you can continue with that one as a second one. Yeah.
Okay.
Yep. Not to worry. You can look at my assignment. It won't be touching so much about this lah. But it's good for your learning. Yeah, I will be maybe it will be in the final exam. So better go to listen to both recording. Yeah, it will help you to understand further. Okay.
Okay.
Munira, any question?
No, madam.
Okay, good. Mahmud, any question from you?
No question. Thank you.
Okay, thank you. So with that,
Doctor, how about the hours on in Ramadan? Will it be enough?
Yeah, that's good. A good question. Only 3 of you in this class. So what time you prefer the class to be?
I am also there, doctor.
Sundus, yeah. Sundus, are you in the campus or in your campus?
I am in the campus, yeah.
All right. Mahmud also in campus, right?
Yeah, I'm in the campus.
And also Muhammad Bilu?
Yes, doctor. Yes.
All of you are in Malaysia. So do you want the class to be in afternoon? Are you available in the afternoon?
Afternoon, like will it be face to face or online?
Online, but if you want it to be face to face, it's better in the morning. Are you okay? But Munira is not in the campus, right?
Yes, madam. I'm not in the campus, but my house is
nearby. So you are willing to go to campus as well?
Yes, it will be no problem.
All right. Maybe okay. But what if we do online first during Ramadan? Because I live in Kajang, which is 2 hours if I have to drive to the campus. So I'm the one reluctant to go to the campus actually, because it's very far from my house, especially on Ramadan. It's very hectic traffic, very heavy traffic. So from week 8 to week 14, Dr. Romzi will be conducting the physical class because he lives nearby, and then he's willing to come to the campus. So during his session, we will conduct the physical class. Okay, but okay, for my session, even though it will be online, but do you want it to have the class in the morning or afternoon rather than at night? Because all of
Afternoon.
from
Online.
So afternoon or morning?
Afternoon.
Afternoon. What about Munira?
Yeah.
Afternoon or morning?
I will go with majority, but I prefer morning.
Munira prefer morning. Okay, what about Mahmud and Muhammad Bilu?
Yeah, I don't have choice. Whatever they decide, it's okay.
Okay, I would prefer morning because usually morning we are fresh, right? Morning.
Yeah.
Because if afternoon, I afraid we will be very sleepy because Ramadan usually we will be very sleepy in the afternoon because we have to wake up early, right? For sahur. So can we do in the morning? Maybe are you all free on morning? 10 a.m.
Yep, inshallah.
10 a.m. is a bit far. Can we do it like on 9 or 8?
Yeah, better 9 a.m.
Yeah. Yeah,
9
9.
Yeah, can 9 a.m. so that we can stop at 12. Okay, so start from next week, the class would be morning 9 a.m. to 12 p.m. Okay, everybody?
It is okay.
Okay, okay. That's
Okay, good. All right, so see you next week. Take a good rest and hopefully this Ramadan will be the best for all of us.
Doctor, when will it be the assignment?
Okay, I will give the assignment after this. We'll give the assignment after this.
So we have to do it before the next class?
Yes, no, I will give you 2 weeks to do the assignment. The assignment carry 30%.
Okay, okay.
2 weeks. All right?
Okay.
Thank you very much. Bye-bye. Assalamualaikum.
Waalaikumsalam.
Thank you.